Hi, Todd VanDenburg here with VanDenburg Capital Management and another uncommon sense update. So I don't know about you, but the past couple weeks in the markets have just been unsettling. I guess that's a good word for it. Um, Primarily because there's just been so much volatility, mostly to the downside. In fact, a couple of days ago, we had the worst day in the Dow for 2019. It was just a bad day. It was down 750 points. At one point, it was down like 900. Um, just 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 unsettling. And so why is this volatility happening? And really, in my opinion, it comes down to two things. One, the Federal Reserve actually lowered interest rates, and as I've said in prior updates, that just makes no sense to me. There's not a single person or business that I know of who's not doing something because interest rates have been too high. Those people just don't exist. So if the intent of this lowering of interest rates is supposed to help the economy, you got to wonder how. And in fact, I read through the minutes of the Fed's meetings, and their commentary could have just as easily justified a rate increase as a rate decrease. So there's got to be some other reason. Now, some have argued that it's because President Trump pressured him into doing it, and maybe that's true, maybe it's not. But I think there's something else that nobody's talking about that might also be contributing to why they did what they did. And that is, our national debt is roughly $22 trillion. And it's gone up by over 100% since President Obama took office. We had like $9 trillion of debt when President Obama took office. And because of the financial crisis, the government started spending more and more money. And here we are, 10 years later, and the debt is upwards of 22 trillion. But here's what hasn't changed. So when President Obama took office, we paid an amount of interest on our debt, $9 trillion. And the interest that we pay on the debt today of $22 trillion is about the same amount of money. So the cost of borrowing all that money is basically the same. The interest payment is the same today, roughly, as it was back when the debt was $9 trillion. And the reason for that is, with interest rates as low as they are, we've been refinancing debt, from 20 and 30 years ago at much, much lower interest rates. So we're able to borrow that money and actually lower our cost of financing. And so, we owe twice as much, and the interest remains flat. So the problem with that, and why I think the Federal Reserve may have actually lowered interest rates, is I think they see some handwriting on the wall here, and that is, the federal government's adding $1 trillion or more to our debt every year now. That's just a regular thing. And we're going to reach a point where the amount of interest that we pay is going to go up. And that would certainly be accelerated if the Fed started raising interest rates. So this is just pure speculation. It is my opinion. But I think part of what they're doing here is they're sort of getting ahead of the problem that if they raise interest rates to more historic averages, by 2% higher than they are right now, then our interest cost on our debt could skyrocket to eat up a third to half of all federal revenues, and that could happen in a 5 to 10 year time frame. So I think the Fed might actually try to keep interest rates where they are now, or artificially low, for a lot longer than I think any of us ever expected. But that uncertainty, causes volatility in the market, because when you lower interest rates, you're sort of implying that there's something bad going on. And again, when you look at the economic data for the United States, you just can't find data to support that kind of a conclusion today. Now that brings me to the second part of the volatility, and that is President Trump tweeting about tariffs on China. So he started a little over a week ago. He said that we're going to put an extra 10% tariffs on $300 billion of Chinese imports, and that immediately caused the markets to drop. And this news back and forth, China then a few days ago said, fine, we're not going to buy any of your agricultural products anymore. So that's about $9.2 billion of sales of U.S. agricultural products that aren't going to be made to China. But let's put that $9.2 billion into context. The agricultural sector in the United States makes up about $132 billion of total GDP. So this $9 billion that won't happen, yeah, it's significant to the agricultural sector. It absolutely is. It's not the end of the world, but it's a significant problem. But that $9 billion problem, as a percentage of our $21 trillion GDP, is like a rounding error. And again, I'm not minimizing what it means to people in the agriculture sector, but to the total economy, to the United States of America, it's not the thing that we should be worrying about. We should be worrying about, are we going to give in to China, basically saying, fine, playing a game of chicken, and if we're the one that blinks or turns away, then they're just going to go back to what they've been doing for a long time: currency manipulation, stealing our intellectual property, not playing fair in a global trade environment. I mean, they've done really bad things that we've let them do for decades and decades. So the volatility really is, okay, if we're in a trade war and the media just keeps harping on this, this trade war, it's the end of the world, people are concerned, and that's why the market's so volatile. But I just want people to put into context that if we lose $9 billion of agricultural sales to China, as a percentage of a $21 trillion economy, it's not really significant. Again, it is to people in agriculture. And I have little doubt that the government will find some way to compensate those people one way or another, because that's just what government does. Government is good at spending money. But it isn't the end of the U.S. economy. In fact, I actually mentioned this to somebody else earlier today. If you think about it, if the U.S. isn't selling agricultural products, grain, soybeans, rice to China, then that means we now have a surplus in the United States, and that should cause the cost of those things in the United States to fall, which means the prices of those foods that are made with those products should fall. So it's not everything is all bad all the time, as we might hear from the media. So just be aware of that. This is normal volatility. Well, normal. It's abnormally volatile, but it's become the new normal. We're just in an environment where we're doing overseas trade by tweet. The president tweets about he wants interest rates to go even lower faster, which again, in my opinion, makes absolutely no sense. And this is the new normal. These tweets are moving the market. And as evidenced by the fact that when you look at options trading, and options trading are often a reasonable indicator of the bias in the market. About a month ago, there were way more options being traded that were betting the market was going up than the market was going down. And you look as of yesterday, and that has completely reversed. There are now lots of speculators that are buying options with the expectation that the markets go down, and that actually causes the market to go down. So we got to be careful to not get trapped into these things because, like yesterday we had a good day in the market. If you get on the wrong side of the speculators, you can make an emotional decision that has lifelong implications to your financial security. So before anybody makes any trades or changes what they're doing simply because they're afraid, talk to your investment professional, give us a call, we're happy to help, but get some advice from somebody who follows the math and not just follows the media. Because the hype and the hyperbole is, can cause you to do things that are against your own best interest. So that was your update. I hope you enjoyed it. If you did, give us a like, give us a share, and I'll be back next week with another Uncommon Sense update. Thanks for watching. If you'd like to be the first to hear of more Uncommon Sense updates like these, please click the subscribe button below. We'd really appreciate it. Thanks again.